Disclaimer.
Pop quiz. What happens when the world's largest silver refiner suddenly stops selling to the rest of us? We're about to find out in 48 hours, and most Americans have no idea what's coming. On January 1st, 2026, China implements export restrictions on silver that will fundamentally break how global metal markets have operated for decades. You won't see this on the evening news tonight, but Elon Musk saw it coming and publicly warned this is not good when the announcement dropped. Why would the world's richest entrepreneur sound alarm bells over an industrial metal most people associate with jewelry and old coins? Because China controls 65% of global silver refining capacity, and they just flipped the off switch for Western buyers. Here's where it gets interesting. While you were planning your New Year's celebrations, something unprecedented started happening in metal markets that should grab everyone's attention. Physical silver trading in Shanghai hit $82 per ounce at the exact same moment our COMEX futures market in New York crashed from $80 down to $70 within a matter of hours. Think about what that means for a second. The same metal, traded on the same day, showing an $8 to $12 premium gap depending on which side of the Pacific Ocean you're standing on. That's not a pricing inefficiency. That's a market telling you the emperor has no clothes. According to data from the Shanghai Futures Exchange, Chinese buyers are paying premiums we haven't seen since the silver squeeze of 1980 when the Hunt brothers tried cornering the market. But this time, there's no conspiracy, no manipulation scheme, just raw supply and demand physics playing out in real time. When physical metal trades at massive premiums to paper contracts, the market is screaming one message loud and clear. There is not enough actual silver to meet demand at current prices. Let me put this in perspective with a scenario you can relate to. Imagine you're buying concert tickets online and the website shows tickets available at $70. You click purchase, but when you try to actually claim your seats, you discover the only way to get them is paying $82 to a scalper outside the venue because the official tickets don't actually exist. That's essentially what's happening in our silver markets right now, except we're talking about an industrial metal critical to solar panels, electronics, batteries, and countless technologies our modern economy depends on. The COMEX exchange in New York, where most Western silver futures trade, operates on a system where buyers can either settle contracts in cash or demand physical delivery of metal from registered vaults. These vaults are supposed to hold the silver that backs all those paper contracts. Here's what should terrify anyone paying attention. COMEX registered silver inventories have lost 1/3 of their metal since September. We're not talking about a small drawdown or normal fluctuation. 1/3 of the silver that was supposed to be sitting in vaults backing futures contracts has simply vanished in less than 4 months. Where did it go? Follow the shipping routes east. Meanwhile, China's domestic silver market entered backwardation in late December, a technical term that sounds boring until you understand what it signals. Backwardation means futures contracts are trading below spot prices, the exact opposite of how commodity markets normally function. In plain English, Chinese buyers are willing to pay more for silver delivered today than for promises of silver delivered next month or next year. Markets only go into backwardation when participants believe physical supply is scarce and getting scarcer. This is a once-in-a-generation supply crisis signal, and it's flashing red 48 hours before China's export restrictions take effect. The Bank for International Settlements tracks global precious metals flows, and their data reveals something fascinating about the timing here. China didn't just wake up one morning and decide to restrict silver exports. They've been preparing this move for months, quietly building domestic inventories while ensuring their solar manufacturers and electronics producers have secured supply before cutting off the outside world. According to customs data, Chinese silver imports surged 20% in the third quarter of 2025, right before they announced restrictions for the new year. Think about the coordination required to pull this off. Major industrial consumers need advance warning to stockpile materials. Refineries need time to redirect supply chains. Government officials need to draft regulations and licensing requirements. None of this happens overnight. This was a calculated strategic move, and we're seeing the final pieces fall into place as the calendar flips to 2026. You might be wondering why silver specifically. Why not gold, copper, or any other industrial metal? The answer reveals just how dependent our modern economy has become on this one element. Silver has the highest electrical and thermal conductivity of any metal. It's irreplaceable in solar panels, where each installation requires roughly 20 grams of silver for the photovoltaic cells that convert sunlight to electricity. It's critical in electronics, medical devices, water purification, and increasingly in new battery technologies that promise to revolutionize electric vehicles. China recognized years ago that controlling silver refining capacity meant controlling leverage over global technology supply chains. According to the World Gold Council's Industrial Metals Division, Chinese refineries process nearly 2/3 of all silver mined globally, even silver initially mined in Mexico, Peru, or the United States. The metal gets shipped to Chinese facilities for refining, then theoretically flows back into global markets. That's how it worked until now. The new licensing system China announced requires government approval for any silver exports, and only producers with refining capacity above 80 tons annually can even apply. That's a massive threshold that eliminates smaller operations and concentrates control among state-owned or state-influenced enterprises. If this approach sounds familiar, it should. China used the identical playbook with rare earth elements back in 2010, imposing export restrictions that sent prices soaring and left Western manufacturers scrambling for alternative supply sources that took years to develop. Here's what makes this moment different and more urgent than the rare earth crisis. Silver markets operate on razor-thin inventories compared to gold. While gold mining produces roughly 3,000 tons annually with hundreds of thousands of tons sitting in vaults and central banks as strategic reserves, silver mining produces about 25,000 tons yearly with barely 10,000 tons in known above-ground inventories available for industrial use. There's no strategic petroleum reserve equivalent for silver, no government stockpiles to release in an emergency, no backup plan if refining capacity suddenly gets cut off from Western markets. The math is brutally simple. Our industries need silver every single day. China just monopolized the refining process and put up a toll booth, and in 48 hours, that toll booth opens for business under rules Beijing controls completely. You're probably asking yourself what this means for you personally. Maybe you're not in the solar business or manufacturing electronics, but think about your retirement account, your investment portfolio, the purchasing power of your savings sitting in dollars. When critical supply chains get weaponized and markets disconnect from physical reality, it creates ripple effects that touch everyone. The divergence between Shanghai's $82 silver and New York $70 futures is not just an arbitrage opportunity for sophisticated traders. It's a warning signal that price discovery in Western markets has broken down. According to Federal Reserve data on commodity flows, the United States imports roughly 40% of the refined silver our industries consume annually. Almost all of that refined silver came from Chinese facilities or flowed through Chinese trading channels. Starting January 1st, all of that supply requires explicit government permission to leave China. Permission that can be granted, delayed, or denied based on Beijing's strategic priorities rather than market prices or commercial contracts. We're watching in real time as paper markets crash while physical metal surges, as vault inventories drain while demand accelerates, as export restrictions take effect while industrial consumption shows no signs of slowing. The pieces are all in position. The clock is counting down. And most Americans have no idea the silver market is about to undergo a transformation that will reshape commodity trading and industrial supply chains for years to come. The question isn't whether this supply shock will hit our markets and our economy. The question is whether you'll recognize what's happening and understand the implications before the rest of the crowd figures it out. Now let me show you the evidence that proves this isn't speculation or fear-mongering, but a mathematical certainty already playing out in shipping manifests and vault inventory reports. October 2025 marked the single largest monthly silver export from China in recorded history. According to customs data published by China's General Administration of Customs, 660 tons of refined silver flooded out of Chinese ports in that single month. To put that in perspective, that's roughly double China's normal monthly export volumes, and represents nearly 8% of annual global silver mine production leaving the country in just 30 days. Why would China export record amounts of silver just weeks before implementing restrictions designed to keep silver inside their borders? Because they were front-running their own policy announcement, giving domestic industrial consumers one last chance to stockpile before the gates slammed shut. Chinese solar manufacturers, electronics producers, and battery makers knew exactly what was coming and rushed to secure supply while they still could. Think about the game theory here for a moment. If you're running a solar panel factory in Jiangsu province and government officials quietly inform you that silver exports will require licensing in 60 days, what's your move? You buy everything you can immediately, damn the price, because you know foreign competitors won't have that option soon. That's exactly what happened, and Western vault inventories paid the price for China's domestic stockpiling spree. The London Bullion Market Association tracks precious metals inventories at accredited vaults across the United Kingdom, which serves as one of the two major Western silver trading hubs alongside New York. LBMA vault holdings have declined 40% from their peak levels, dropping from over 35,000 tons down to barely 21,000 tons remaining. These aren't minor fluctuations in a stable market. This represents a systematic drain of physical metal flowing from west to east at an accelerating pace. Here's where the story gets even more revealing. While Western vaults were hemorrhaging silver throughout 2025, Shanghai's own warehouse inventories hit 10-year lows according to data from the Shanghai Futures Exchange. Wait, that doesn't make sense at first glance, does it? If China was importing record amounts and restricting exports, shouldn't their inventories be building up rather than declining? The answer tells you everything about where this silver is actually going. It's not sitting in warehouses or vaults waiting to be traded. It's being consumed immediately by Chinese industrial manufacturers operating at full capacity. Those solar panel factories aren't buying silver to hold it as an investment or speculative position. They're buying it to turn into photovoltaic cells that get installed on rooftops and solar farms across China and exported as finished products to the rest of the world. According to the Silver Institute's World Silver Survey, industrial applications now consume over 50% of global annual silver demand, with China alone accounting for roughly half of that industrial consumption. Chinese manufacturers use approximately 13,000 tons of silver annually, most of it in solar panels, electronics, and increasingly in emerging battery technologies. That consumption doesn't stop or slow down just because global inventories are tight. If anything, China's renewable energy mandates and industrial policies are pushing consumption higher year after year. This brings us to the structural deficit that makes the current supply crisis inevitable rather than merely possible. For 5 consecutive years, global silver markets have operated in deficit, meaning total demand exceeds total new supply from mining and recycling. The numbers from 2025 paint a stark picture. Total demand reached approximately 1.24 billion ounces, while total supply from all sources topped out around 1.01 billion ounces. That's a deficit of over 200 million ounces in a single year. Now multiply that across 5 consecutive years of deficits, and you're looking at roughly 1 billion ounces of silver that had to come from somewhere to meet demand. Where did it come from? Existing above-ground inventories in vaults, warehouses, and strategic stockpiles got drawn down to fill the gap between what mines could produce and what industries needed to consume. You might be thinking that mining companies could simply increase production to eliminate these deficits and rebalance supply and demand. Here's why that won't happen fast enough to matter. According to data from major mining operations in Mexico, Peru, and the United States, silver is primarily produced as a byproduct of mining other metals like copper, zinc, and lead. Only about 30% of global silver production comes from primary silver mines, where silver is the main target. This means silver supply is largely determined by demand for base metals, rather than silver prices alone. When copper prices are low, copper mines slow production or close, which reduces silver byproduct supply regardless of what silver itself is trading at. Even if silver prices doubled tomorrow, you can't just flip a switch and increase production from mines that are fundamentally designed to produce copper or zinc with silver coming along for the ride. New mine development takes years of exploration, permitting, construction, and ramp-up before producing significant output. The Silver Institute estimates it takes 7 to 10 years on average to bring a new major silver mine from discovery to full production. That timeline means any supply response to current high prices won't hit markets until the early 2030s at the earliest. We need silver today and tomorrow, not in 2033. Meanwhile, recycling provides roughly 15% of annual silver supply, mostly from industrial scrap, photography waste, and old electronics. But recycling rates have plateaued because modern electronics use smaller amounts of silver per unit, and recovering it from complex circuit boards is expensive and energy intensive. According to the U.S. Geological Survey, recycling efficiency has improved but can't scale fast enough to offset growing industrial demand or compensate for production shortfalls. Let's talk about the licensing system China just implemented, because understanding the mechanics reveals how deliberately this was designed to maximize Beijing's control. Under the new regulations, effective January 1st, only silver producers and refiners with annual capacity exceeding 80 tons can apply for export licenses. That threshold isn't arbitrary. It effectively limits licensing to approximately 15 major state-owned or state-influenced enterprises, while excluding smaller private refiners and traders who lack the scale to qualify. Even more revealing, the licensing system requires exporters to demonstrate they're meeting domestic demand first, before receiving permission to sell internationally. In practice, this means Chinese government officials can approve or deny export applications based on domestic industrial needs, strategic priorities, or geopolitical considerations, rather than pure commercial terms. If solar manufacturers in Guangdong need more silver for panel production, export licenses get delayed or reduced to ensure domestic supply, regardless of prices foreign buyers might offer. This is the rare earth playbook from 2010 playing out again in real time. Back then, China controlled over 95% of global rare earth processing and used export quotas to restrict supply, setting prices soaring and forcing Western manufacturers to scramble. Rare earth prices spiked by over 400% in some cases, and it took nearly a decade for alternative supply chains to develop in Australia, the United States, and other countries. The difference with silver is that alternative refining capacity is even more concentrated in Chinese hands, and the industrial dependence runs deeper across more sectors of our economy. According to the U.S. Geological Survey, America has exactly 0 primary silver refineries with capacity above 50 tons annually. We have small-scale operations and facilities that process silver as a byproduct of other metals, but nothing approaching the scale of Chinese refineries in Henan, Hunan, and Jiangxi provinces. Canada has some refining capacity through operations in Ontario and British Columbia. Mexico produces significant silver from mines, but ships most of it to Chinese refineries for processing. Even Australian mining output often flows through Chinese facilities before entering global markets as refined metal meeting LBMA good delivery standards that industrial consumers require. China recognized years ago that controlling refining capacity, not just mining, gives them leverage over the entire supply chain. You can own the biggest silver mine in Nevada, but if you need to ship your ore to China for refining, and they control the licensing for getting your refined metal back, who really has the power in that relationship? The solar industry's silver consumption illustrates just how much leverage this creates. Each gigawatt of solar panel capacity requires approximately 25 to 30 tons of silver for the photovoltaic cells. According to the International Energy Agency, global solar installations are projected to exceed 400 gigawatts annually by 2027. Do the math. 400 gigawatts times 25 tons per gigawatt equals 10,000 tons of silver needed just for solar panels every year. And that's before accounting for growth in electric vehicles, 5G infrastructure, medical devices, and other emerging applications. China produces roughly 80% of the world's solar panels and consumes more than half of global silver dedicated to solar applications. They're not restricting silver exports to hurt their solar industry. They're restricting exports to ensure their solar manufacturers have guaranteed supply, while foreign competitors scramble to find metal at any price. The inventory drawdowns, the export records, the licensing restrictions, and the systematic deficits all point to the same conclusion. This isn't a temporary squeeze or a speculative bubble. This is a fundamental restructuring of who controls silver supply and who has priority access to an industrial metal our modern economy can't function without. The evidence is sitting in customs reports, vault inventory data, and production statistics that anyone can verify. The proof is already here. The question is whether our markets, our industries, and our policymakers will recognize it in time to respond effectively. Now, let me walk you through exactly what happens next and why the window for positioning ahead of this crisis closes in a matter of days. January 2nd through 6th, 2026. Mark those dates because that's when the mathematical reality of this supply shock hits COMEX futures markets with full force. Here's the mechanism that makes this inevitable. Arbitrage traders exist to exploit price differences between markets. When physical silver in Shanghai trades at $82, while COMEX futures sit at $70, that $12 spread represents free money for anyone who can buy the cheap contract and sell the expensive physical metal. But here's what makes the first week of January completely different from normal arbitrage opportunities. Every trader who bought COMEX futures at $70 expecting to deliver into Shanghai at $82 just discovered that Chinese export licenses are now required. Processing times are undefined and approval is discretionary. The arbitrage trade that looked like easy profit suddenly carries political risk that professional traders can't price or hedge. So what do instead? They demand physical delivery from COMEX vaults, driving up delivery requests at the exact moment when registered inventories are already down 1/3 from September levels. The math here is straightforward. COMEX registered inventories currently hold roughly 40 million ounces of silver available for delivery. Daily, silver futures trading volume regularly exceeds 100 million ounces in paper contracts. If even 10% of contract holders demand physical delivery during the first week of January, that's 10 million ounces flowing out of vaults that have already lost 1/3 of their metal. 3 or 4 days of heavy delivery demands could drain registered inventories below critical levels where the exchange has to acknowledge they can't fulfill physical settlement. According to the Commodity Futures Trading Commission, large speculators and commercial hedgers have been reducing short positions in silver futures throughout December. That's unusual behavior if traders believed prices were going to fall. These are professional commodity traders at banks and hedge funds who spend millions on market intelligence, and they're positioning for exactly the squeeze we're describing. Now let's talk about the demand catalyst that makes this supply crisis permanent rather than temporary. Solid-state battery technology is moving from laboratories into production timelines for 2026 and 2027 commercial rollout. What you might not know is that leading solid-state battery designs use silver as a critical component in the solid electrolyte layer that makes the technology work. Industry estimates suggest solid-state battery adoption could add 200 million ounces or more of new annual silver demand by 2027 to 2028 as production scales up. That's roughly 16% of current total global silver supply that needs to come from somewhere. Remember, we're already running 5 consecutive years of deficits before solid-state batteries add a single ounce of new demand. Let me put those numbers in context. Imagine your household budget, where you're already spending 10% more than you earn every year, draining your savings to cover the gap. Now someone tells you that starting next year, your expenses will increase by another 16%, while your income stays flat. That's the math facing global silver markets over the next 18 to 24 months. Major manufacturers including Toyota, Nissan, and Ford have announced solid-state battery partnerships and production timelines targeting late 2026 for initial models. According to their announcements, they're betting billions on solid-state technology because it solves range anxiety and charging time problems that have limited EV adoption. This demand growth isn't speculative. It's locked in based on technological choices already made. This brings us to the gold-silver ratio, which currently sits around 60 to 1. The ratio compresses, meaning silver gains relative to gold, when industrial demand for silver increases faster than investment demand for gold. We're entering exactly that environment. Over 50% of mined silver each year gets consumed in applications where it's not economically recoverable, according to the Silver Institute. That silver is gone from the supply pool permanently. In 2011, when solar demand was accelerating and supply was tight, the ratio compressed from 65 to 1 down to 32 to 1 in less than 12 months. Silver didn't just keep pace with gold, it outperformed by a factor of 2. Right now, with gold trading around $2,600 and silver at 70, the ratio sits at 60 to 1. If that ratio compresses to 30 to 1, which happened as recently as 2011, you're looking at silver in triple digits, even with modest gold appreciation. Here's what you need to understand about the opportunity available right now. Western investors can still buy silver at $70 to $75 per ounce through COMEX futures, exchange-traded funds, or physical dealers. That's happening while physical metal in Shanghai trades at $82 and Chinese buyers are paying premiums of 10 to 15% over spot prices because they understand physical supply is scarce and getting scarcer. You're essentially buying at a 15% discount to physical market reality. That mispricing exists because most market participants haven't connected the dots yet between Chinese export restrictions, vault inventory drawdowns, and the delivery squeeze hitting COMEX markets in the first week of January. According to CFTC positioning data, retail investor interest in silver remains muted compared to historical peaks. This is what opportunity looks like before the crowd recognizes what's happening. The window closes when one of several triggers forces price convergence. Either COMEX faces a delivery failure and prices spike to ration remaining supply, or Western industrial consumers panic about securing silver and buy aggressively regardless of price, or Chinese domestic consumption accelerates and export availability drops towards zero, or financial institutions holding short positions decide the risk isn't worth the exposure and cover en masse. Any one of those triggers could flip market sentiment in days. The math doesn't care about opinions or predictions. The math cares about 65% of refining capacity under license restrictions, 5 years of supply deficits, 200 million ounces of new battery demand, and 40 million ounces in COMEX vaults facing delivery requests from traders who can't arbitrage into China anymore. This isn't about predicting the future. This is about recognizing present reality that markets haven't fully priced yet. The evidence is in vault inventories, shipping manifests, licensing announcements, and battery technology roadmaps. The opportunity exists because most people are still focused on yesterday as market structure, while tomorrow is reality is already locked in. The $25 divide in our title refers to the gap between where silver trades in mispriced Western paper markets and where it needs to trade to reflect physical supply reality. That gap is closing, whether gradually through arbitrage and delivery demands or suddenly through exchange failures and panic buying. Either path leads to the same destination. Your advantage is understanding what's happening before the mainstream financial media connects these dots and before institutional money managers restructure portfolios to reflect the new supply reality. That advantage won't last long. Once delivery pressures hit exchanges in early January and industrial consumers publicly acknowledge they are struggling to secure supply at any price, the question you need to ask yourself is simple. Do you believe Chinese export data showing record outflows before restrictions? Do you believe vault inventory reports showing 1/3 drawdowns in 4 months? Do you believe solid-state battery manufacturers who are committing billions to technology that requires silver? Do you believe the math on 5 consecutive years of supply deficits? If you believe the evidence, then you understand we're not speculating about possibilities. We're calculating probabilities based on factors already in motion. The path of least resistance is upward because you can't print silver the way you print currency, you can't license supply that doesn't exist, and you can't change the laws of physics that make silver irreplaceable in the technologies defining our economic future. The East just broke the Western market. And now we get to see how long it takes everyone else to realize it.